The Federal Reserve, or the Fed, is America's central bank. It keeps our economy stable by managing the money supply. Think of it like adjusting the flow of water in a pipe. Too much water, and the pipe bursts. Inflation. Too little, and the water doesn't reach where it's needed. Recession. The Fed uses tools like the reserve requirement, the discount rate, and open market operations. By changing the reserve requirement, the Fed influences how much money banks can lend. Adjusting the discount rate affects borrowing costs. Open market operations involve buying and selling government securities to control money flow. These actions impact interest rates, the cost of borrowing money. The Federal Reserve's role is crucial in maintaining economic stability. It strives to keep inflation in check, promote growth, and ensure financial stability. Monetary policy is how the Federal Reserve manages the money supply to influence the economy. If the economy is too hot, inflation, the Fed can cool it down. If it's too cold, recession, the Fed can warm it up. Lowering interest rates makes borrowing cheaper, stimulating growth. Raising rates makes borrowing more expensive, curbing inflation. The Fed's decisions are data-driven, based on indicators like inflation and unemployment. Policy changes operate with a lag, and unforeseen events can complicate efforts. Despite its imperfections, monetary policy is a powerful tool. It aims for stable prices and maximum employment. Fiscal policy and monetary policy are the two main levers the government uses to influence the economy. Fiscal policy involves government spending and taxing decisions. Monetary policy, managed by the Fed, controls the money supply and interest rates. Fiscal policy changes, like tax cuts or increased spending, have immediate impacts. However, they often involve lengthy legislative processes. Monetary policy is faster to implement, but operates more indirectly. Both policies play crucial roles and often work in tandem. Understanding their differences helps comprehend how the government steers the economy. The FOMC, or Federal Open Market Committee, is at the heart of the Fed's monetary policy decisions. Composed of 12 members, they meet 8 times a year. They set the federal funds rate, influencing borrowing costs and economic activity. The FOMC's decisions are confidential and highly anticipated. Critics argue for greater transparency and accountability. Despite criticisms, the FOMC plays a vital role in maintaining economic stability. Their decisions impact not only the American economy, but also have global ramifications. Understanding the FOMC's role is crucial for comprehending our financial landscape. Their influence extends beyond national borders. The Federal Reserve's decisions impact the global economy. The US dollar's role as the world's reserve currency amplifies this effect. Fed actions affect the dollar's value relative to other currencies. This influences the cost of imports and exports worldwide. Emerging markets are particularly vulnerable to Fed policy changes. Higher US interest rates can draw capital away from these markets. This can destabilize their economies, leading to currency depreciation. International cooperation is crucial to mitigate risks and ensure stability. The Fed's decisions highlight the interconnectedness of the global economy